Welcome to The Explainer. Today we're taking a really deep dive into Semtech, ticker symbol SMTC. Now, this is a company where the recent stock performance looks absolutely like a rocket ship, but the financial engine underneath, well, it tells a remarkably complex and, honestly, fascinating story. We're going to look closely at the sky-high expectations the market is currently priced in versus the actual fundamental reality on the ground.
Okay, let's dive right into this. 215.4%. If you've held this stock over the last year, you're looking at a massive, jaw-dropping win that has easily left the broader market in the dust. I mean, the enthusiasm here is palpable. But you have to ask yourself, what exactly is driving this incredible optimism? And more importantly, is it actually fundamentally justified?
To figure that out, here is our roadmap for today. We'll start with the Semtech market boom, compare the top line versus the bottom line, look at pricing the premium, analyze cash flow and liquidity, and then wrap things up with the final tally. Basically, we are going to admire the shiny exterior of this sports car first and then pop the hood to really check the engine.
Let's start with Section 1, the Semtech market boom.
Right now, Semtech is boasting a massive market capitalization of just over $8.2 billion, with shares trading right around $94.40. To put that sheer scale into perspective, the stock was sitting at a 52-week low of just $29.29 not that long ago. The premium pricing of Semtech today is a huge testament to incredible market momentum, lifting it way above those recent lows. But you know, the journey to this peak wasn't exactly a smooth straight line.
Take a look at this extreme volatility. Back in 2022, Semtech suffered a brutal, punishing drop, going down nearly 68%. 2023, still a very tough environment, down another 23.6%. But then, look at what happened in 2024, a massive, aggressive surge of over 182%. The narrative completely flipped. The market suddenly loved what it saw, and buyers rushed in to entirely reverse those previous year's losses.
Moving on to Section 2, top line versus bottom line.
Now, what's really interesting here is the sheer contrast. This is a real record-scratch moment. There's a massive volume of money coming in the front door, compared to what is actually left over as profit at the end of the day. On the top line, Semtech is absolutely a proven billion-dollar revenue machine. They generated $1.05 billion in trailing 12-month revenue. That's an impressive volume of business by any standard. But look right across at the bottom line. A net income of negative $40.3 million. Think about that for a second. They're doing over $1 billion in sales, yet they're losing over $40 million in actual net profit over the last 12 months. So how does that happen?
Well, the answer lives entirely in the margins. The company actually makes a very strong 51.3% on gross sales. So the core economics of the actual products they sell, those are quite sound. But when you start factoring in all the operating realities, we're talking overhead, research and development, debt servicing, administrative expenses, all of that gross profit is completely eaten away. It leaves them with a negative net profit margin of 5.8%. Right now, simply put, the operational cost of running and growing the business are totally outpacing the gross profits they bring in.
That brings us to Section 3, pricing the premium.
So, what does this all mean for buyers today? How much of a premium are investors willing to pay for this unprofitable growth? Before we look at the exact multiples, let's just establish a quick benchmark by defining the margin of safety. This is simply the difference between the intrinsic fair value of a stock, based on mathematical discounted cash flows, and its current market price. Think of it as your financial cushion. If you buy a stock below its fair value, you have a margin of safety against the unknown.
And here is Semtech's margin of safety, negative 303.7%. This is a shockingly negative number, guys. It emphatically highlights just how far the current stock price is decoupled from the mathematically calculated intrinsic value. The market is pricing in massive future growth expectations today, which literally leaves absolutely zero margin of safety for investors buying in at the current price.
Breaking that negative margin down into actual dollars makes the disconnect even clearer. The calculated fair value price for Semtech, based purely on fundamental metrics, is just $23.38. Yet, as we established earlier, the trading price is all the way up at $94.40. The strict math suggests the fundamental fair value is roughly a quarter of what it's trading for right now.
And this brilliantly illustrates how, completely across the board, investors are paying an incredibly high premium to own a piece of this company. We're seeing a price-to-sales ratio of 7.8, a price-to-book ratio almost hitting 16, an enterprise value-to-sales ratio over 8, and because their net earnings are currently negative, the price-to-earnings ratio sits at an inverted negative 214. Any way you slice this data, Wall Street is paying top dollar, betting heavily on what Semtech will become down the road, rather than what it fundamentally earns today.
Section 4. Cash flow and liquidity.
Let's shift gears towards some impartial optimism here, because while the fundamental earnings engine might need some work, the company's financial battery is fully charged to the tune of $165.3 million. That is Semtech's free cash flow over the trailing 12 months. This is the ultimate saving grace, and it explains exactly why investors might still be so incredibly bullish. While accounting rules and non-cash expenses drag the official net income into negative territory, the actual tangible cash generated by the business operations is highly positive. A business can survive a long time without positive net income, but it cannot survive without cash, and Semtech is generating plenty of it.
Beyond just that raw cash number, we also have several stabilizing liquidity factors that impartially prove the company has the resources to easily cover its short-term obligations, even with the negative net income. They've got a positive free cash flow yield of 2.01%. Their current ratio is a very healthy 2.37, meaning they have more than double the liquid assets needed to cover immediate liabilities. The quick ratio is strong at 1.66, and their return on invested capital sits at an impressive 12.6%. The internal cash mechanics of Semtech are functioning very, very effectively.
Which brings us to our final section, the final tally.
It's time to weigh these high-speed market expectations against the fundamental realities. Recapping these glaring juxtapositions really reveals the two faces of Semtech. On one side, you have undeniably incredible momentum, a 215.4% trailing return and over $165 million in strong free cash flow keeping the lights on and then some. But on the other side, you've got steep fundamental hurdles, a negative $40.3 million net income and a deeply negative 303% margin of safety indicating a very, very expensive stock. This company is caught perfectly between high sales and cash generation on one hand and deep net losses and a steep valuation on the other.
So, the absolutely crucial question is this. Is Semtech priced for perfection or positioned for a pullback? The market clearly believes in the growth story, paying a heavy premium for strong revenue and robust free cash flow. But with zero margin of safety and negative net income, any bump in the road could trigger incredible volatility. Based on the hard data we've just unpacked in this explainer, you now have a clear, structured view of the facts. The numbers are on the table. How you interpret the road ahead is entirely up to you. Keep exploring, keep learning, and I'll catch you in the next explainer.